we're giving away 100 ounces of silver to celebrate silver hitting triple digits. Don't miss out on your chance to win. Visit silvertrade.com today to register.
Welcome to the SilverTrade Insider. I'm Dr. John Lindau. Joining me today is Rafi Farber of the Endgame Investor. Thanks for joining us today, Rafi.
Hey, John, thanks for having me. First time.
All right, well, it's going to be a lot of fun. Let's dive right into it with a discussion on the endgame. The endgame for the U.S. dollar certainly appears much closer in the wake of everything that's been going on the last 6 weeks with the Iran war. The petro yuan is rising at the expense of the petrodollar, but this all certainly didn't start with the Iran war. The dollar's been in a free fall against gold for the better part of, 3.5 years now, Rafi? Since the U.S. and Europe confiscated Russia's central bank reserves. I think that was late 2022. Rafi, you've kind of discussed or described the current monetary era as in the end game for fiat currencies. In the context of the petrodollar system, where oil has long been priced in and settled in dollars, how do you define the end game, and what specific triggers are you looking for to signal we've kind of crossed the point of no return?
Well, the definition of endgame is when the US dollar can no longer acquire any amount of physical gold anywhere. The way that I look at the monetary system is through the Misesian principle of monetary regression. Mises is the guy over there in that book, the not the father of the Austrian school, but the guy who united micro and so-called macroeconomics, or the big picture and the small picture together into one unified theory. So according to him, all prices have to be linked back to the past, right? Because the only way logically that you know where you fit into the division of labor today is because you knew where you did yesterday. And the only reason you did yesterday is because of the day before. So there's a continuum that goes into the past. Prices aren't just random signals. They signal very important information about the division of labor in society, and that's how we all function. That's why we don't starve to death. That's where we know what we're going to do. Because if we woke up and nobody knew what to do, we'd be in a zombie apocalypse. We'd all start attacking each other, right? It's funny, but it's true. I mean, prices are extremely important things. And given that the only reason you know what prices are today is because you knew yesterday, therefore, because the dollar started as a receipt, as a certificate for a certain amount of gold, it basically still is that. And the inflation that has been collecting since the beginning of the dollar, really, but has really accelerated since 1933 and then 1971. That's all on top of the gold base. It hasn't replaced it. So the end game is basically when everything on top of the gold base of the dollar is worthless, meaning all the debt that now represents most of the currency supply. When that becomes worthless, then we go back to gold and silver directly because there's no other choice. And then from there, I mean, that itself is a good thing. But as I said before, prices are very important things. They signal where everybody fits in the division of labor. Now, in an inflated monetary signal like we have now, that with extremely suppressed interest rates for decades, and especially since 2008, then that makes price signals of the entire economy make it look like there's a lot of demand for private credit and roll-up and huge firms on Wall Street and trading and algorithms to clip pennies off of a steamroller and that kind of stuff, and all the crazy stuff going on in the economy, OnlyFans and all this really gross flech that's going on and bubbling up everywhere in the world. That's all because of the inflation. So once that goes away, the entire structure of production has to be reorganized. Now, that's good if you know what you're doing. You can work with your hands. You work the land. You know how to farm. You know how to do basic stuff. You're a mechanic. Then you'll be in good shape because there'll be a lot of demand for you. But if you're somewhere on Wall Street or somewhere on OnlyFans working for that business, or anything in between there, or somewhere up in the ether of the economic structure, there's not going to be no demand for you, and you're going to have to find a new thing to do, and that's going to be most people, like more than half of society. I'm not saying half society is in OnlyFans. I don't want people to misconstrue me for that, but they're doing stuff that otherwise would not be economical, would not have signals of profitability in an economy where interest rates have been suppressed to near zero for so long, and that's the end game.
want to get your thoughts a little bit here. You've kind of pushed back a little bit on the mainstream petrodollar narrative, arguing that the US dollar is actually a gold derivative rather than an oil derivative. Can you kind of walk our viewers through why that distinction matters and
Oh yes,
maybe
it's
how it
it's
changes our understanding a little bit?
so yeah, it's pretty important. Um, because if you think that the dollar is an oil derivative, that it gets its power from the fact that there is a petrodollar system, and there is a petrodollar system. I'm not denying that there's a system that we call the petrodollar system. That's a real thing that the U.S. government requires all of its oil trading partners to use to denominate oil prices in dollars. Fine, I agree that that's a thing. But if you don't understand that gold is fundamentally money and the dollar is based fundamentally on gold, then you might make a mistake and stack oil futures or store. You're not going to store oil in your garage, but you'll buy futures, ETFs, invest most of your money in energy companies, that kind of stuff, and you're going to be losing out seriously because the money actually is gold and not oil, and I can demonstrate that if you with a simple chart. You can look it up, pretty easily. Look at oil denominated in gold ounces, and the price of oil is near all-time lows. It went up a little bit since the war, but before the war started in Iran, it was pretty much all-time lows except for the lockdown area when it was negative 35. Okay, so we're going to exclude that. But
Same thing
for
with
above
silver.
zero, for above zero, oil is at near record lows in gold terms. The money is gold because gold is the most liquid commodity. Oil is not a very liquid commodity. It changes radically in dollar terms, and it changes also a lot in gold terms relatively to other commodities that change even less in gold terms. But gold is not, it's never 100% liquid, but it's the most liquid commodity that exists on the planet. And that's why it's money. So the petrodollar system, what it is, it's really something on top of the gold derivative that is the dollar. Right? The petrodollar system is really, it doesn't aid the dollar itself. It aids the dollar's purchasing power, it seems to, by spreading out demand for the debt that is the inflation of the dollar, right? The inflation of the dollar is itself when the Fed buys federal debt, right? And then puts it on its balance sheet and then tosses out the receipts for that, which is US dollars. So that's most of the dollar is debt, right? The dollar is a receipt for everything pro forma on the Fed's balance sheet. Now, what we refer to as the petrodollar system, by forcing its oil partners to denominate in dollars, that forces everyone who buys oil from OPEC and all the other American partners to hold balances of U.S. Treasuries, right? So it spreads out the inflation, so it's not all completely centered on the U.S., which would cause hyperinflation, and it's what will cause hyperinflation when ultimately all of the treasuries that are being stacked in different accounts for the sake of oil purchases when they eventually come back to the US. Eventually, logically, all of it's going to come back to the US. The question is, what's the trigger for that? And whenever the petrodollar system collapses, yeah, I mean that's going to happen, and then the dollar and gold are no longer going to be exchangeable at all, and then we're going to have to go back to gold as money and not oil as money. Oil in such an environment, right, where the dollar where all the debt in the world has gone back to U.S. shores for whatever reason, and the petrodollar is destroyed, the demand for money is going to be much higher than the demand for oil because you need oil for a lot of stuff, obviously, but you need money for everything, right? Because it's the most liquid commodity, that is what makes it money, because with that, we can divide our labor. You can't divide labor with oil. You can only do it with a much more stable, much more liquid commodity, and that happens to be gold. It could be silver. In the absence of that, it could be copper, but oil is like way down there in the the ranking of liquid commodities.
So let's kind of bring that home. What, in your viewpoint, is the trigger for that? I mean, we're certainly seeing some warning signals flashing with um, kind of concurrent events with Iran. Iran's trying to accept anything but the dollar for their oil with what's going on in the Strait of Hormuz. China is manipulating the situation to try to get everything sold in yuan. So, how big of a role do you think this whole Iran war is going to play in that?
I don't know. I hear different news coming out every day with Iran. I have no idea what's really happening. I'm here in northern Israel, and I can tell you that the war has calmed down a little bit, but we still have soldiers up in Lebanon. The war is still going on. Um, and apparently Iran can't sell any oil now because their ports are blockaded. All right. So that turns the tables on them. I don't know what's going to happen, but oil would is more expensive than otherwise. If there's some kind of deal worked out, then maybe the situation can calm down. But the Iran war could be a catalyst, or it could be 100 other different things, or it could combine into something that eventually will spill over. But what I'm looking at for what is going to cause this to finally materialize is the weakest link in industries that would be affected by higher interest rates. So right now it's private credit, right? That's the crisis that's going on now. And private credit essentially is the same thing as subprime mortgages were in 2008. In subprime mortgages, you had companies that were loaning money out to consumers to buy houses who couldn't pay back the loans. So you would loan them out at higher interest rates in order to get those interest rates, because interest rates were already manipulated even back in 2000 to 2008, even before the 2008 financial crisis. They were still lower than they should have been, which encouraged firms to loan out to borrowers at higher interest rates that couldn't pay back the loan. So it's the same thing with private credit, right? You have these Wall Street firms that are loaning money to these actors that are saying they're going to roll up all these businesses, loan them money at 6%. They'll pay it back at 8% when they make these roll-ups more efficient by decreasing quality and streamlining everything. But then interest rates go up, they can't pay back the loan, and that defaults, and then it goes down the chain, and then a whole bunch of banks can't open for business the next day. We saw it with Silicon Valley Bank. So I don't know what triggers this, but I know it is triggered by a banking crisis. And just as it always is. And when there's going to be the next banking crisis, my thesis is that it will be the last one, because it's going to require, you know, 10, 12, 15 trillion dollars of bailouts, because every series of bank bailouts has to get bigger and bigger and bigger. And there's only one more. And after that, the dollar's going to lose some purchasing power, and it's all going to flow into gold, right? Because the dollar is the derivative, and then the purchasing power doesn't disappear. It goes somewhere. It goes into money itself, whereas the dollar is not money, it's credit.
So do you have a target like for gold and silver in that event when that banking crisis happens, or do you think like the dollar itself just goes off the board?
In terms of a gold value, well, the target would be logically, if let's assume that the gold exists in the on the Federal Reserve's balance sheet, that it's there, okay? Because some people say it's not. So I'm saying that it is. If it's there, then wait, hold on one second. Just can you edit this out? Because there's some kind of like burning smell, and I got to check it out.
Yeah, that's fine.
Hold on. I'm just gonna pause the record. I'll be back. All right. Um, so if you take the Fed's balance sheet and you assume the gold is there, then if all the other stuff goes to zero, right, then all the value goes into what remains. Right? That's the most extreme scenario. I'm not saying necessarily we'll get to the debt will be zero. I think it'll be very much devalued. But so basically, you take the amount of stuff that's on the Fed's balance sheet, which is like $6.8 trillion dollars, and then you divide it by the amount of gold that's held on the Fed's balance sheet, which is about 235 million ounces, and then you come up with a number, right? So it's about if the goal is going to cover 100% of the Fed's balance sheet, meaning the other stuff is zero, which has happened before. It happened in 1979, 1980. It actually went up to 130%, right? At $872 in 1980, the value of gold on the Fed's balance sheet covered 130% of all the other stuff that was there, all the inflation on top of it, all the debt. We could get there again. So the dollar number on that is about $50,000. It's somewhere around there, like 55, 60. It changes depending on how much stuff is on the Fed's balance sheet, which changes all the time. So that target changes every time the Fed inflates again. So, I mean, it could be anything. But the point is that I believe that almost all of the purchasing power today for all the stuff that dollars can buy today is going to like slam into gold and silver because the debt's going to be worthless or very close to it.
Sure. Central banks have been a huge buyer of gold really for a few years now, while the dollar share of global reserves has um, held steady and starting to actually shrink a little bit. Does that support your view of de-dollarization being more of a myth than reality, and that like gold, not another currency, is the real replacement for the end game?
I don't think it supports um or argues against it. What's the other word for supports? Or I'm losing my vocabulary. I don't think it provides evidence either way. Um, because first of all, from an Austrian school perspective, the Austrian School of Economics is entirely positivist. It doesn't deal with empirical proofs. It's a logical school, right? It's all deductive. Right? And so deductively, because of the regression principle, all gold is money because that's where the currency comes from, and because of going back into the past. So, leaving that aside, we discussed that already. The question is, does central bank purchasing of gold demonstrate that gold is money? I don't think it does. I don't think it's very relevant. I'm not saying it doesn't affect the price. It does affect the price sometimes. While they're buying it, the dollar price is going to go up. But the reason that central banks buy gold is not because they think gold is money. It's because they want to use it to support their currencies if their currencies get into trouble. Right? And that only works very ephemerally. We saw that during Weimar, the bank, the central bank of Weimar. I forgot the central banker's name. Is a famous guy, or infamous guy. But they tried to sell gold in order to support the market. And it worked for a little bit. It worked for maybe like a month or two in 2020, late 2022, early 2023, but that was it. Uh, so central banks will do what they do. But remember, like central banks are kind of stupid. It's not like they know anything. What was it the
You
famous
think they
Gordon
do?
Brown gold bottom, right? Gordon Brown sold all the Bank of England sold all of its gold or a lot of its gold at the 2000 bottom, and and there was this article about it, like him saying, "Oh, gold is not worth it, and we're going to look out for our citizens in the United Kingdom," and like they don't know anything, and like Turkey, for example, Turkey has a lot of gold, but it goes up and down, right? So one month they buy a whole bunch of gold, the next month they sell, or the next quarter they sell it, and it goes like zigzags. And does it help their currency? No. I mean, they have the lira, and it sucks. Right? It's not worth anything. So yeah, I don't pay attention to what central banks do because I think they're idiots.
Let's talk a little bit about silver here. Silver often gets overshadowed in macro discussions, but silver is also a monetary metal. Now, it's not a pure monetary metal like gold. It also is a critical industrial metal as well, but it does have those dual properties. It is still money, in my opinion. I mean, some people might disagree with me in the current age, but I think it's still money. So I guess in your endgame framework, why is silver poised for outsized gains, or is silver poised for outside gains compared to gold? Do you view it as money?
Yes, I view it as money. I'm gonna say I view it as money. I think it is money. I think the definition of there's no one thing that's money and another thing that isn't. There's no like hard line between this is money and this is not money, right? It's like there are black things and there are white things, and there's like a scientific difference between what wavelength of light they reflect at your eyeball, right? So and you can measure that, but there's no hard definition of this is money and this is not money. There's a continuum. There's degrees of liquidity, right? The most liquid commodity, the one with the least transaction costs, is going to be money because in order to transact in it, you want to have the least amount of transaction costs because otherwise nobody would use it. Right? If it costs too much to transact, like how much does it cost to transact in oil? A lot because it eventually gets burned or it's messy. And how are you going to contain it? How are you going to move it from one person to another? You have to put it in a container and so it can't spill, and you got to carry it around, and that's going to cost a lot of money just to do that. So gold has the least transaction cost. Now, the question is, when do the monetary properties of silver become revealed again? right? So, because silver is a very liquid commodity, but if you look at the price of gold and of silver in dollars, it seems to be less liquid. However, before 1873, the dollar was born as a silver derivative. It only became a gold derivative in after 1873, and that itself, right? That itself was a proto move of a wealth transfer from the middle class to the rich, from the poor and the middle class to the rich, because the poor and the middle class used silver as money primarily, and the rich used gold as money because they had more, so they could afford gold, whereas the middle class and the poor used silver. So if you're going to make the dollar into a gold derivative instead of a silver derivative and then lock it down at some kind of ratio, right? And you say, everyone, give us your 15 ounces of silver, and we'll give you $21 which will be now an ounce of gold. So that's going to move all of the purchasing power that was once in silver from monetary demand and move it into gold and give all that purchasing power to the rich at the expense of the poor and the middle class. It's the same move over and over. We see it every generation, right? With the 2008 bailouts, with the COVID bailouts, it's going to happen again with whatever bailout's going to be next. Except if you're smart, then you're going to have gold and silver so that, when everything gets flipped around, the purchasing power will be in your hands. So back to the basic question is, when does the liquidity of silver overtake that of gold? And my answer is when gold derivatives can no longer divide gold honorably or reliably on a retail basis. If the dollar does, if you have a functioning derivative that stands in for gold, that can divide gold much better into retail amounts, right, than a silver coin can. A silver coin can do it pretty well, but passing it around, it's cumbersome and it gets rubbed out and it loses weight over time. There's it's not perfect. There's problems with it. So a gold receipt is like a dollar is better because even if it's crumpled, it's still the same value, right? And it's much more convenient. But if the gold derivative cannot be trusted on a retail level to divide the gold itself, then you have no choice at all but to use silver as the divider into retail amounts, right? There's nothing else to use. You could use copper, but silver is probably better. If you have no silver, then you use copper. And if you have no copper, then maybe use, I don't know, iron or whatever they use for coins in really, really poor countries, right? So I believe that when the dollar collapses in the initial stages, silver is going to go back to somewhere around a 15 to 1, maybe 20 to 1, maybe 10 to 1 briefly, something around there for a while until such a time as there's enough trust in a new system to create a new credit derivative that will divide gold on a retail level. Until then, you'll have to use silver. So I think we're going to go down. I think we're at like 65 to 1 now. We're going to go back down to the historical ratio, somewhere around 15 to 1. Not exactly there, but that's what I'm looking at for immediate endgame. And once we hit there, I'm going to get rid of most of my silver and keep gold, and then start collecting capital, and we'll see what I can do to fix the world or help.
Yeah, I mean the mining ratio is even lower than that. It's around 7 to 8 to 1 out of the ground right now for silver versus gold. That's about half of the historical ratio. Let's talk a little bit about the futures markets. We've seen persistent physical drain from COMEX warehouses and record delivery notices in gold and silver futures. In the recent run up, we've seen even China's vaults in Shanghai went down to like 8 or 9 million ounces. The COMEX was down to about 70 million ounces of registered silver. And the COMEX keeps falling. There's some speculation now that China is trying to build back up their inventories from the COMEX. Shanghai's inventory has gone back up. It's up to about 16 million ounces now, but COMEX is still going down just about every day, another little over 3 million ounces yesterday. Do you think these developments are early warning signs that the paper pricing mechanism is breaking down, or is it just merely a function of the silver supply deficit?
Well, I've been following the COMEX silver stocks, the amount of silver and gold that they have for a while, and I check it, every few weeks. And I do see what's happening, that the supplies are draining, but they're still pretty high historically. Gold especially. Gold is very high. The amount of physical gold stocks, the amount of outstanding paper is almost 1 to 1. right now. People talk about the fractional reserve system in the futures, and that's true. Um, but it's a lot less of an issue than it was, let's say in 2000, when I think it was like, 30, 40 to 1. Right? But open interest now in gold and silver are both very, very low. So rather than looking at the absolute supplies of metals in the COMEX versus in Shanghai or something, I'm looking at the fact that the prices of the metals are different, right? The premiums in China we call it a premium. We could just call it a New York discount. It's the same thing, right? The fact that the prices of gold and not gold yet, but silver
Silver.
in China is so much different and consistently so now. It's been that way for months. It's a signal that the market is breaking into different pieces, which in a world, in a unipolar world that we've grown up in, people of our generation, where America was a superpower, and even during the Cold War, America was much more economically powerful than Russia, and it was still basically a unipolar world, even though the USSR was a threat. Right? But since 1989, it was even more unipolar. In a unipolar world like that, where one country has all the power and it's like, it's being Matila, it's fear. It's pushing the fear of it on the entire planet, keeping them in line. You can have unified global markets. Right? In a world where people start questioning the power of the superpower of the world, then prices are going to start breaking up because the empire has to manage its outposts. Wars break out in the periphery. That's what October 7th was. It was another war breaking out in the periphery of the American empire. I know Israel is a piece of the American empire, in one way or another. So the empire is breaking apart, and you can see that in the fact that prices of oil are different in different areas of the world. Prices of gold and silver, mainly silver, are different areas of the world. It's just a sign that, just like the Roman Empire, its markets were breaking apart once it turned from a republic into an empire, and then had to manage everything, and then started losing wars in the periphery. This has all happened before in history, and when it happens, markets break apart, and that's natural. So it's gonna keep getting worse, and there's nothing artificial about the fact that silver has two different prices in two different places, because the same good in different places is very different. They're different goods, basically. That's what Mises said also. Just because something is the same good chemically or physically, it doesn't mean it's the same good if it's in a different place, right? Water, ice in Antarctica is a very different good than ice at the equator in Ecuador, where you need to cool off. That's basically the idea.
All right. Well, for our audience viewers who are stackers, investors who hold physical gold and silver, um, let's talk a little bit before we wrap up. What practical steps or mindset shifts do you recommend right now as we move deeper towards this end game transition?
Well, mindset shift. So the main one that you should keep in mind. Keeping a mindset in mind. Well, that's redundant, but okay. The main mindset shift that you should have is that gold is not a hedge against inflation. Gold is just money that's not inflated. All the inflation is on top of it. Right? So, regardless of what the dollar price is of gold and silver, it's still money, because they are the most liquid commodities. Maybe their monetary prices relative to other goods and services are not completely revealed yet, but that's what is going to happen regardless of what the price is on any given day. So if you're stacking that, you're stacking money, and you will be able to spend it directly once the dollar no longer functions, because there will be nothing else to do. There will be no other choice. The other mindset that I try to keep in mind, try to have, is that when this happens, I'm not doing it. I'm not doing it solely to save my family or to help my friends or to ensure my own future. I understand that the division of labor that we have now is based on an extremely inflated ticket for gold, call the dollar, that is going to break down. And once it does, the division of labor is going to change radically, and a lot of people, millions, maybe billions, are going to be ejected from it. Right? And those people need to be reintroduced into the division of labor, or they are going to go crazy and they're going to become violent. The best way to do that is to stack gold and silver now. And once the prices of capital plummet in gold and silver terms, because the division of labor is on the verge of breakdown, because the dollar no longer functions, then our job will be to push gold and silver into the system, make it circulate as fast as possible to rebuild a division of labor with the least amount of zombie apocalypse terror that we can stomach. Right, the faster that we get gold and silver back into the system, the more stable things will be. The more people that stack it now, the more stable, the less scary the end game will become. Because if more people have money, then if the dollar collapses, they still have purchasing power. They can still fit into a division of labor somewhere. They can still be useful. So we're doing it for the planet. We're not doing it for our families, though our families are important. This is really a civic duty that we all have to do, and that's what I try to keep in mind.
All right. Well, before we wrap up, can you tell our viewers a little bit more about the Endgame Investor newsletter?
Yeah, the Endgame Investor on Substack. I publish about 3 times a week there. And while I teach monetary lessons like these, I try to keep it, I try to, I guess, shape people's minds in a way where they think about gold and silver as money and they see themselves as part of this, this cleanup crew to help the world once this happens. And I track, the banking system and the money and the monetary conditions, and of course the war, the geopolitical situation that's going on now, and my place in it here. I happen to be near the center of it, so I have, I can see missiles flying out of my window sometimes. So it's getting kind of exciting, and I try to keep it funny and positive, and less doomsday, and more like, look, we have a job to do, so let's do it, and let's do it together.
All right. Well, sounds good. For Rafi Farber and Dr. John Lindau, thanks for tuning in to the SilverTrade Insider.